Hey everyone, this is Brant from Wolf on Wall Street Trade and the technicaltake.net. We are going to get to the market in just a minute, but first I want to talk about the last few weekends of videos that I've been putting out, the Fed's panic rate cut, and basically what I thought was going to happen as a result of that. I said panic rate cut because the Fed was slated to cut rates by 25 basis points. They went into media blackout. And then they kind of leaked it to their Fed whisperer at the Wall Street Journal that they were going to go 50, right? So I think Powell got spooked by the employment reports that were coming in and that 818,000 job negative revision to the year ending March 2024. And then last weekend's video, did the Fed light the fuse? Did they light the fuse on what? Reflation. So for subscribers that subscribe to my service at Wolf on Wall Street Trade, this was the first post the morning after the Fed. Reflation in Q4. That was my call, and so far that is what we're seeing. In this video, I'm going to give you a couple ways that you can break it down. We all have like different lenses or filters that we see the market through. It doesn't matter if you're a day trader or an investor. Maybe use moving averages, Bollinger Bands, whatever the case may be. We all make sense of the market in our own way, and there's no wrong way. So it's really important to just find what works for you. But as far as what I'm going to share with you, we have our lenses of how we see things, and I'm going to give you mine. But before we do that, we're going to take a quick look at the market. So S&P 500, this is a weekly chart, by the way, up 0.2% this week, basically unchanged. The Dow was up 0.1%, basically unchanged. Dow Transports. So this trend line that you see over here is a massive zone of resistance going back to May 2021. Every time the transports try to get above this, they just get knocked back down below. So again, this is a weekly chart. This is the weekly candle. Dow Transports being the worst index of the week, down 2.3%. NASDAQ 100. Notice it's not making new highs. So right over here, mid-July, as we entered Q3, tech got hit and something really significant changed. We'll go over that a little bit more, but NASDAQ up 0.1% on the week. IWM, small caps, this is the ETF for the Russell 2000. They ended the week down 0.5%, but they mitigated those losses. They were down almost 2%. I'll show you exactly why. Small caps just have not been able to catch a bid outside of short covering. This is a 2-minute chart of IWM, and in white is my most shorted index. You can see Wednesday into Thursday, shorts are starting to cover. Friday, they cover big. Small caps had a big day on Friday. That mitigated the losses on the week. Anybody who is a subscriber to Wolf on Wall Street Trade knows about this. If you've watched enough of my videos, you've probably seen this. Small caps try to break out late in a bull market cycle. So what generally happens is large cap tech runs the bull market, and towards the end of the bull market cycle, late in the bull market cycle, money starts to come out of those, and then investors try to rotate. Small caps haven't been getting any love this whole time, so they are considered at this point usually deep value. They see the value of small caps, they try to rotate into them. So this happens all the time. This is a 2-day chart of IWM, and these are instances of it happening back here in 2018 in this range. Try to break out. Failed breakouts often lead to fast reversals. Over here in 2019 into the COVID crash, we see them try to break out again from this range. Boom, fast reversal. Here is the end of 2021. That's a 2-week breakout. Did not last. The rotation failed. We went into about a 6 or 7 month bear market. And then we've had this basically big 2-year range, and small caps trying to rotate in. They're well off record highs, as you can see. And it just looks like a much bigger fractal of all these other instances. This next chart will show you that kind of rotation over here, the attempt, as money came out of the NASDAQ. So this is the NASDAQ. This is the IWM in white. This is that July, mid-July breakdown in large cap tech, mega cap, semiconductors, and here is rotation the same day, trying to rotate into small caps. So this wasn't just a willy-nilly thing. I mean, this was some big money trying to rotate into those, and it was a failed rotation. As you'll see, it was probably one of the strongest attempts that I've seen. So here it is right here, mid-July. You can see really big volume. This is actually a bullish ascending triangle consolidation. You can see a lot better on an intraday chart. And this is the failed breakout. And then look at this heavy volume on that fast reversal. So we've seen a couple other, weak attempts here. But point being, I haven't seen small caps really run on their own without that short covering dynamic. And that short covering dynamic only goes so far. Speaking of, I'm going to show you that next, and here it is. Okay, so IWM over here in the candlesticks, and this is my most shorted index. Now, we did have a huge, powerful run in November into December. It was led by small caps. This was after the S&P had come down from 4,600 to 4,100 right here at the end of October going into November. Now, this most shorted index, you can't see it on this chart, was the lowest it's been since 2018, meaning shorts, because the market had trended down for 3 months, S&P lost 500 points. Shorts were really bared up, and this most shorted index was lower than the COVID crash. It was all the way back to 2018. That means there were a lot of shorts to squeeze, and that's why you see this really big short squeeze move in the most shorted index. But recently we've kind of settled into this range. Here the shorts get bared up and they get in too early, they get squeezed. But what I'm trying to show is this red kind of area, which is this range of where these short squeezes have been running out of momentum. This is that attempted rotation. Again, hit kind of the top of this most shorted index range, ran out of short squeeze momentum. Small caps just aren't doing it on their own, and it's just the wrong economic environment for small caps to really thrive, and we're going to talk about that in a little bit. As far as S&P sectors on the week, basically split. Again, this is a weekly chart. The two of the sectors that I've liked into Q4, into that reflation theme, are the two sectors that did the best this week, and this one blew everything else away by far. The energy sector up 6.9% this week. There was nothing even close to that. So in second place was my other pick that I like into Q4 for that reflation theme, which is the counter-cyclical or defensive utility sector. For subscribers, you know about the reflation bounce in kind of the first half of the year where inflation bounced up. So if we look back to like December, the market was pricing in 7 rate cuts for 2024, and they were expecting the first one back here in March. But this reflation, okay, this inflationary bump, and I'm not talking about, anything huge, but big enough to keep the Fed on hold, was why they didn't cut in March, why they didn't cut in July. And here we see, this defensive trade that I'm going to talk a little bit more about, but also utilities are kind of going to do better in that reflationary environment. Now I want to briefly touch on how you kind of figure out that environment. Everybody's got their own lens of how they view things. So if you're a trader, you might use Bollinger Bands, or you might use Fibonacci levels, or whatever. But you make sense of the market in your own way, and there's no wrong way. So when we're talking about the kind of economic environment we're in, it matters a lot, because the stocks that are going to do well, or the sectors or style factors that are going to do well, depend on that economic environment. And there's basically 4. The 2 main inputs are always the same. They are growth and inflation. And you may have seen this in other places, but it's just basically pretty much an overall concept that a lot of hedge funds use. At least the really big ones, and then the smaller ones just pay somebody else to kind of do it for them. But you basically have 2 ways growth and inflation can go. So growth can accelerate or decelerate. Inflation can accelerate or decelerate. That gives you 4 probabilities, right? Or 4 scenarios. So they look like this: growth and inflation accelerating, This is kind of where small caps tend to do well. Growth accelerating and inflation decelerating. If you've ever heard people talk about like Goldilocks, the economy's Goldilocks, this is the Goldilocks scenario. Then we have what my call has been for Q4, which is growth decelerating, inflation accelerating. The inflation accelerating is part of what will cause the growth to decelerate. And then growth and inflation both decelerating. This is generally the environment where you get market crashes. Okay, so like 2018, remember 2018 from like October to actually it was Christmas Eve. It was December 24th, right? And then the plunge protection team met. That was this environment where growth and inflation were decelerating and the Fed was hiking rates into it. So it was a really bad combination, and Powell learned a pretty hard lesson. So the one I think we're in right now is this one, which is basically stagflation, stagnating growth with accelerating inflation, accelerating off of the recent lows. Doesn't mean accelerating to an all-time new high or anything like that. Probably the best way to do this would be if you were like a data scientist, or you're really good with Excel spreadsheets. And if you are and you want to work together on this, I would love to hear from you. Like I said, everybody has their lens. My lens is price action. So what was I watching as all of this was unfolding? I was watching copper. Sometimes you'll hear people refer to it as Dr. Copper, because Dr. Copper is fantastic with inflation deflation. So we can see the first half of the year here where we have H1, that's the first half of the year 2024 reflation. Copper is inflating. And then over here, this is the deflation that allowed the Fed to finally cut rates in September. Okay, so I'm looking at this higher low over here, and I'm watching copper at like 431, 430, 431, about ready to break out, going into the September Fed meeting, right? Or the September FOMC. And I'm watching copper. I'm like, okay, what's going to happen? If the Fed cuts by 50, I think copper is going to break out, signaling reflation. And that's exactly what happened. So the Fed cuts, we see this nice big breakout in copper, and copper has reflated, I don't know, for like 5 or 6% since then. Also, I look at this, which is the copper gold ratio. You can look at kind of this inflation or deflation. You can kind of see it breaking out over here. But what it's really good at telling us is where rates are going. So if you remember when inflation was just on fire and the Fed was pouring gasoline on it by keeping rates at 0% and still buying assets, they were pouring gasoline on the fire of inflation, and they were calling it transitory. It's going to just, go away on its own. It didn't go away on its own. This indicator, for subscribers that have been with me that long amount of time, you probably remember this indicator, and I was saying, look, this is saying that the 10-year yield should be at least double where it's at current levels, and I think it was around like 1.5% back then. So if we add the 10-year yield, you'll see what I'm talking about. They move pretty much in sync. So since the Fed, this is yields. Yields have just soared. This is the inflation of the first part of the year. This is deflation. And here we're inflating again. So this is exactly the risk that I was talking about that the Fed took in cutting by 50 basis points. So if they cut 25, this probably wouldn't be an issue. But they cut by 50. So now rates are moving higher because commodities are moving higher. They're inflating. So rates are working against the Fed. We look at the 10-year yield over here. This is a daily chart. Here's the FOMC, the day of the FOMC. And the 10-year yield since then is up 30 basis points in less than a month. It's heading towards 4%. So these Fed decisions, they have consequences. And kind of being able to game those out ahead of time gives you an idea of what kind of things you want to invest in. So for Q4, commodities, the energy sector, utilities. Another one that I've been keeping an eye on and have told my subscribers I think this can go higher is oil. But there's been this really pesky resistance. This is WTI crude futures, by the way, on a 30-minute chart, and I've highlighted 72. Pesky resistance at 72. Doesn't matter what happens. There's just no geopolitical risk premium being priced in. We're getting these crazy unsourced stories from Reuters, from the Financial Times, from the Wall Street Journal. Sources familiar with talks, right? They won't name a source, so they're just BS stories. OPEC actually called them out on their Twitter account. So this is OPEC this week calling out the Wall Street Journal, basically saying that they're fake news. As you probably know, last week, Iran fired a whole bunch of ballistic missiles into Israel. So we did get a pretty nice move there. It still did break out above 72. Can you believe that? Finally did, above 72. President Biden was asked on Friday, how Israel is going to retaliate. Obviously, I think, striking nuclear facilities a month before U.S. elections is probably off the table. To me, what made the most sense was that they go after Iran's financing, their ability to finance proxies like Hezbollah, and that would be going after their oil income and hitting their oil facilities. So President Biden was asked about that, and I think he said words to the effect of, I think they should consider something else. Of course, he's going to say that. We're a month before an election. One of the main issues in this contentious election is inflation. Now, I'm not blaming Biden for inflation. I mean, inflation was coming no matter what. I'm not saying, I agree with all of his policies or anything, but it doesn't really matter who was in office. That was coming. But we did see oil move down a little bit on his comment and that heavy volume right there. But still, we got the breakout. And as I had said to subscribers, like if you're on top of it, you're watching it, and WTI breaks out above 72, I would jump on it because CTAs, commodity trade advisors, are short oil. Hedge funds were the most bearish of oil that they've been in history. So that means a lot of short covering. I think we could actually get more. This is one of those assets that should reflate. And here is a look at it. So we still do have, this is the peak of the reflation earlier this year. So we still do have a trend of lower highs. So we'll still have to see WTI make some progress above 78 to really break that trend. You can't really see it too good down here, but we have some decent oil and, decent volume on this move in oil. Another one I've liked all year, and I still like it. It still should do pretty well in this kind of economic environment is gold. So let's take a look at gold futures. And if you're a subscriber, the first half of the year, all I was saying, I really want to see gold consolidate for a good long time, build a nice strong base to break out into later this year and into 2025. Here is that big consolidation over here. Here's the breakout. And we're just seeing bullish price action, like bull flags here, a bull flag over here. Volume wasn't fantastic in this little area right over here. But if we get a decent sized consolidation here, that will just kind of take care of that, I think. So gold, as making all-time new highs, is still looking really good. Of course, it had a big knee-jerk reaction to the payrolls report. But considering how much yields were up and how much the dollar was up on Friday, gold just performed like a champ, I thought. The market ahead. Okay, if you're a subscriber, you heard me say this in this past week or two. I think that investors made a lot of money in the first half of the year, and with the AI frenzy and all that, in my very humble opinion, I think they are trying to run out the clock. They are playing defense into the end of the year, trying to hold on to those gains and post those gains for the year. And if we look at QQQ here on a very long-term 3C chart, 3C's in orange over here, by the way. Here is the whole, accumulation before the AI thing. And we can see, on shorter time frames and back like in June and stuff, we were seeing, money already coming out. We could definitely see that, as of now. So 3C's like quite negatively divergent. Over here is positively divergent. Over here it's like confirming, which is what you should see. But there is a negative divergence here. And I think, some money has come out. I wouldn't say it's at the level of like distribution of like heavy selling and short selling and stuff like that. I think there's been like profits taken, and they're kind of playing it defensive right now, trying to run out the clock, as I said. So in any case, the only thing that I can really, or that strikes me, is that when NVIDIA's CEO, Jensen Huang, sold $700 million in NVIDIA stock this summer, right? So if you hear that the CEO of NVIDIA is doing that, there's a lot of reasons you can sell stock, but one of them isn't, hey, I think this is going like a lot higher. I think that probably played a part in what we're seeing over here on this 3C chart. And again, I think it kind of looks like booking profits and hoping to kind of hold on to those and ride them out into year end, play a defensive game, run out the clock. Speaking of that defensive rotation, here is the example of it. That's NASDAQ 100. And this is an equal weighted index of defensive sectors, or you might call them counter-cyclicals. So stuff like consumer staples, utilities, the healthcare sector. You can see as that money comes out, which was exacerbated too by the carry trade unwind in the dollar yen. But you can see almost the exact same day, money's coming out of those stocks, mega caps, AI, all that. It's rushing in to these defensive sectors, and then they just have been tearing higher ever since. But now that we're getting into this kind of Q4 stagflationary environment, I don't think all the defensive sectors are going to do well. So an example would be consumer staples, stuff like Walmart. If costs go up, commodities go up, input costs go up, that pinches their margins. So that's why I have gone from being like bullish on all the defensive sectors to narrowing that down to a certain few. If we take a look at the Semiconductor Index, the SOX Index, this looks like a head and shoulders to me. It looks like a left shoulder, a head, and then this kind of being like the high area of the right shoulder, and there's some resistance up here just above 5,300. That's the neckline. Because SOX is an index, we don't have volume, so next best thing will be SMH, the ETF for semiconductors. Let me pull that up real quick. Now the problem with like head and shoulders is like kind of seeing animals in clouds. It's really, subjective, I think. What is extremely important is to verify volume. So over here on this rally to form kind of the left shoulder, volume doesn't matter at all. It starts to matter a little bit over here. It gets really important in this area in the head, and then it gets even more important as you move to the right. So in a healthy rally, it doesn't matter what the asset is, if it's any kind of stock, if it's semiconductor index, if it's oil, if it's Bitcoin, doesn't matter. On a rally, you should see green volume increasing. On a pullback, you should see red volume decreasing. The opposite of that happens in a head and shoulders top. So I've got the volume here for SMH. This is a 200 bar average or 200 day average of volume. And we can see over here to kind of left, let me move this over just a little bit. We can see this kind of price rally and volume is increasing. Over here, as price comes down, we can see this red volume increasing. Now on this rally up to the head and up to what became the all-time high and a key reversal day for the SOX index right here, which are nasty things. In any case, what we don't see is the green volume breaking above this 200 bar average, but as price comes down, we're seeing the red volume increase. Again, rally, green volume, not even breaking above the 200 bar average of volume. Price comes down, volume, red volume is increasing. A little rally over here, or a bounce, whatever you want to call it. Volume, green volume is declining. That is what you typically see, what you should look for in any kind of a head and shoulders price pattern. If you don't have that, it's just a random price pattern. It's a giraffe in the clouds. So there's that key reversal day, by the way, in the SOX index at the very high, and here's where everything kind of breaks down. This is where I was posting my video, Stranger Signals, and that the thumbnail for that video looked like this. A bunch of weird volatility signals in there, stuff that I don't see very often, and that I posted on, I think it was the 14th of July. Let's pull up the NASDAQ real quick. And a pointer, so I posted it on the 14th, which I think was a Sunday. So the next day, the 15th, right there, that is before we get this, what is this, 15% sell-off in the NASDAQ. So that video was quite timely, I think. And one of the things that I said we were getting a signal on is a very, very high probability proprietary indicator I have that gives a signal over the last 20 years. I'd say, gives it maybe once a year, but we hadn't seen anything since Q1 of 2022, which is right before we entered a bear market, until this video. And what happened? Bam, VIX was up over 400%. Had some subscribers trading this. I had one guy I know that was up over 100,000. I know one guy that booked 50,000. And VIX is a very, very difficult, or volatility is a very difficult instrument to trade. But the point is, we were getting those signals back here in June with this indicator. I would say the average move, when it gives a signal, the average move in VIX is about 50%. I would say the probability of that move over the next 30 days is about 90%. So it's one of the highest probability signals that I have, that I've ever seen, in fact, for volatility. And it gives a signal when it closes below 14. A couple weeks ago, 2 to 3 weeks ago, it was up in the 50s. This week, it's been down in the 18s and 19s. On Friday, it closed at 18.95. So we may very well get another long volatility signal before the end of the year. So that's something to keep an eye on if you're a subscriber. I will definitely have posts that are unmistakable that say, we have this signal in our indicator. As far as the broader market, if you have this view of, I'm either long or short the S&P, it's a very limited view, because there's a lot of things out there, if you know kind of what the environment is, that you can be long or you can be short at different times. For instance, commodities, let's look at the CRB Index. It's inflated over 10% off September lows. So commodities, you can buy commodity index ETFs. You can buy different commodities like copper, right, or oil. When the S&P is like doing nothing, like this week, there are assets that are doing well. Another was emerging markets that I threw in there. This is one of my emerging market picks. And look at the trend. I mean, it's doing awesome. I said that I would stay away from China unless China stimulates. And with the Fed cutting 50 basis points, they opened the door for China to do exactly that. The POBC cut rates, People's Bank of China, and the government vowed fiscal stimulus. They haven't come through with it yet, but they vowed it. So investors were very, very, very underweight China, very short China in hedge funds, and we've seen massive move. Here is FXI, the China 25 ETF. Let's see if we can find September 18th, when the Fed cut. There it is. So since the Fed cut and the PBOC stimulated a couple days later, 31%. Or if we look at Chinese internet, K-Web, and you can see the market wasn't looking good before that, 43.5%. I think a lot of this is short covering, and what I would look for is a big consolidation or even a pretty deep pullback. If we get that, I think investors will push the Chinese government to follow through on that stimulus. If we do get that price pullback or a nice consolidation, then I think we can look into that. But I don't like chasing stuff like this. It's up this big. Or gold, here's the GLD ETF. I mean, look at this thing. Monster move. Gold's making all-time new highs. S&P is up 20% year to date. Gold has beat it. It's up 28% year, or GLD anyway, it's up 28% year to date. So there's other things to buy than just the S&P or the NASDAQ. In the meantime, I think there's a lot to buy in commodity land. A little bit skeptical on bonds right now just because we're seeing some reinflation, but TLT is kind of the longer end of things, but I'm still kind of just holding off on that for the moment. I do like it. I do think it's going to do well later. If we're going through kind of like a Q4 reflation, yields and bond prices move opposite of each other. So higher yields, lower bond prices. If you liked the video, please give it a thumbs up. And if you haven't subscribed, please subscribe. I'd love to have you. We'd love to have you. Also, in the video description, you will find ways to contact me. You will find the websites where you can subscribe. And you will find my Twitter handle at Wow's Trade on Twitter. I post a lot of stuff on there. Enjoy the rest of your weekend.